Hello and good afternoon, everyone. We'd like to welcome you all on to this month's event on year-end tax planning strategies. It's great to host everyone this afternoon. If anyone has got any technical issues throughout the event, please do feel free to contact us using the chat function. And we will be having a question and answer session towards the end of the event. So please do feel free to post your questions in the Q&A box as we go through, and we'll pick these up and address these at the end of the event. So my name's Carl Taylor. Also on the panel this afternoon, we've got Jack Bennett, who's an advisor from our tax team here at Oldfield. Hello, Jack.
Afternoon, Carl. Good to be on.
So this event is really all about looking ahead as we come up to the end of the tax year, which ends on the 5th of April, 2023. It's also really about looking ahead as we come up to the end of the calendar year, which is actually the financial year end for many of our clients. And it's really about looking at the strategies we need to employ to achieve the best outcomes from a tax perspective in this tax year and in this financial year. And the recent autumn statement that was made on the 17th of November has also introduced new changes. It's really changed the landscape yet again, and introduced new changes to the tax allowances that will bear on tax planning strategies that we employ right now. So we're going to talk about those. We've really broken this down into three main areas. We're going to follow up on key actions from the recent autumn statement. We're going to talk about planning for your financial year end, talking about strategies around that. We're going to talk about pre-tax year end strategies. We're going to wrap up with a summary of the key takeaways, and we're going to have a question and answer session right at the end. So I'm going to launch in with some of the key actions we need to be thinking about from the autumn statement. We did have an event immediately following the autumn statement on the 17th of November, and in that event we covered some of the detail on various announcements that were made that impact directors and shareholders of companies. There's really a collection of reductions in allowances and tax increases that are all combining to impact companies. I'll just summarize those on this next slide here. And you can see there's these sort of three key points here. Corporation tax rate is increasing to 25% from 19% as it is now, from April 2023 onwards. We've got dividend tax rates increasing. So that's already happened. The dividend tax rates increased by 1.25% across the board at all levels in April this year. And so that's already happened. And that increase in the dividend tax rate was introduced at the same time as the health and social care levy, the increase in national insurance at that point. That has actually since been reversed, but the increase in dividend tax rates hasn't been reversed. So that seems like it's here to stay. And then thirdly, we've got the dividend allowance. This was a new point that was announced in the autumn statement last month. The tax-free dividend allowance that everyone can earn that's currently £2,000 in this tax year. And that's actually reducing to £1,000 next tax year and then down to £500 in the tax year after that. So quite a significant reduction there in the dividend allowance, in the amount of dividends that you can receive tax-free. There's other measures as well, like change in the additional rate threshold, etc. And so it really sort of feels like companies and shareholders and directors of companies are being almost attacked from all angles. With increases and changes in the allowances. And it's a real question of, what's the best remuneration structure going forward for director shareholders? I think there's really three big questions that are coming up with a lot of our clients, which I'm going to touch on briefly. So I just pulled those up on the slide there. Number one, should we stop paying dividends and start paying ourselves a high salary instead? Because this will be tax deductible at 25% going forward. That's a question that's coming up quite frequently, I think, at the moment. Secondly, what are the other tax efficient remuneration options? And thirdly, what's more tax efficient? Is it more tax efficient to be a company, or is it more tax efficient to operate as a partnership or self-employed going forward, taking into account all these changes? So I'm going to just take these questions in turn briefly and try to answer them. So first question, should we stop paying dividends, pay ourselves a high salary instead, as this will be tax deductible against 25% tax going forward? It is a common point that's coming up, a common question that's out there, I think, in general. I think there's a lot of people talking about this and saying that possibly paying a salary is better than paying dividends. But we've done some detailed calculations on this at different income levels, spanning right from £50,000 of income per shareholder up to £1,000, £1 million per shareholder. And from those calculations, we can confirm that paying dividends is still definitely a more tax efficient remuneration strategy than paying a big salary. And when we looked at it always round, it was really the fact that at the basic rate, employees have to pay employees national insurance at 12%, and that on top of employers' national insurance at 13.8%. Both of those things combined really make the salary option quite a costly route and not as tax efficient as paying dividends. So it's quite an interesting exercise to do those calculations, and it's really quite clear that paying dividends is still the more tax efficient strategy. The only caveat to that is that if someone is spending significant amounts of their time on research and development, on R&D, then that changes the picture slightly. And again, just sort of looking at that, if a typical director is earning between 50 to 100,000 per annum, they'd really need to be spending more than 60% of their time on R&D to make it worthwhile switching over to paying a high salary. So that's just break even, if you like, 60% of somebody's time spent on R&D. So really you need to be spending a fair bit more than that to make it worthwhile switching to a high salary. Probably need to be spending sort of 75% of your time, something like that, on the qualifying R&D activities. So second question, what are the other tax efficient remuneration options out there? Well, firstly, we've established that paying dividends is still more tax efficient than paying a high salary. But the other tax efficient remuneration options, that's a huge subject, and there's many other ways to structure your remuneration tax efficiently. I think the critical point on that really is to plan ahead and to try and think ahead to what you're likely to want to draw out of your company in the next 3 years, maybe 5 years, if you can think that far ahead. I mean, it's much better to work out a strategy to extract that tax efficiently ahead of time. Much more effective to do that than trying to patch things up later. Other more tax efficient remuneration strategies would include using trademarks, royalties, pension contributions, interest on loan accounts, etc. They're all brilliant routes to extract funds out of the company in a tax efficient way going forward. Third question here, which is more tax efficient, limited company or partnership or self-employment going forward, bearing in mind these changes in the tax rates? Again, this is a pretty huge question, and ultimately the answer really does depend on your profitability, on your circumstances, how much you want to draw out of your business and so on. But basically we've run some multiple calculations on this, taking into account the new corporation tax rates, the new dividend allowances, and actually when you boil it down, the changes are still actually quite small overall, and really our feeling on it hasn't changed following doing updated calculations. Running your business through a limited company is still tax efficient. It can still be very tax efficient, provided you're retaining 20% plus of your profits in the company. In reality, we find most of our clients do that because they have to retain profits in their businesses to fund growth. So really, situation is basically largely unchanged. It does depend a bit on your profitability, but largely, incorporation is still a tax efficient way to go. It was just one of the sort of key announcement from the autumn statement, which we thought would be worth mentioning, and that is the fact that the inheritance tax thresholds have been frozen until 2028. So previously, it had been confirmed that these thresholds are going to be frozen until 2026, but it's now been extended until 2028. So you can see, I just pulled that up on screen there. These are the current inheritance tax nil rate bands for an individual. So you've got the 325,000 nil rate band there, and then the additional 175,000 residence nil rate band basically equates to 500,000 per individual, or $1 million per couple in total. But the key point really is that those thresholds have been frozen until 2028. You might say, well, that doesn't really sound very dramatic. We've just frozen the thresholds. They're just going to stay the same until 2028. Doesn't sound very exciting. But the fact is that house prices are never static. Obviously, it's uncertain what's going to happen to house prices in the short term, but 2028 is 6 years away. And these thresholds being frozen, it will mean that many more people have to pay inheritance tax at 40% unless they do something about it. So it's just to point that out. It is really critical that we regularly assess your potential exposure to inheritance tax and that we have an action plan to mitigate the impacts of any inheritance tax liabilities. So going to hand over to Jack, who's going to talk a bit more about the pre-financial year-end planning that we need to think about.
Thanks, Carl. It's certainly going to be interesting when you look at the financial year-end planning. It's going to be interesting to see how businesses adjust to the 25% corporation tax rate. So I thought it'd be useful just to start off with just a bit of a refresher on how this transition will work to 25%. So for any company with a financial year ending up to 31st of March 2023, the rate will remain at 19%. And then it's the following year where you'll have these effective transitional rates. So you can see them on screen there. So for example, if your year end is September, so your year to 30th of September 2023, you'll have an effective corporation tax rate of 22.01%. And many of our clients will be on December year end, so 31st December 2023. So in that year, there'll be a rate of 23.52%. So in the examples I want to look at, we'll be concentrating on a December year end, but just to bear in mind that if your year end isn't in line with December, the same principles will apply. Just the rates might be slightly different. So firstly, thinking about capital expenditure. Now, when you take into the mix, we've got this change in corporation tax rate, and we've also got the super deduction finishing. And both changes have transitional implications. So it isn't always very clear when you should be buying capital assets. And this has especially been the case recently with a fairly quick succession of changes in tax policy. So for simplicity, we've just set out 4 scenarios here. Now, this is based on, each scenario is based on buying £100,000 worth of super deduction qualifying plant machinery. So on the left-hand side, we've got what it'd be if you bought it in the year to 31st December 2022. So the first line is the amount we can offset against our profits. Then we've got the corporation tax rate. And then the third line is the important one. It's the tax that is you'll be reducing your corporation tax liability by. So we can see that December 22 picture there. We've got our full super deduction against 19% corporation tax. Now, without going into the technical detail of the calculations, you can see from that the amount you can offset against your profits changes in the period, 3-month period to 31st of March 2023, and then it changes again. So from 1st of April, you've just got the full 100% annual investment allowance. And then the rates of corporation tax are obviously changing as well. So in both the 2023 examples, you've got the transitional rate there. And then from 2024 onwards, you got the full 25%. So in looking at the tax savings, in reality, it's fairly marginal when you consider that this is £100,000 worth of capital expenditure. So I think the key point to really take away is, where possible, any super deduction qualifying assets should be purchased before 1st of April 2023, just for optimum benefit. And then moving on a bit, when we usually look at the end of the financial year, we usually recommend bringing forward expenses where possible, in order to offset them against your current year profits. This year, however, it'd actually be more tax efficient to defer costs where possible and thus reduce your taxable profits in a period that has a higher corporation tax rate. So I've included some examples on this slide, and just focusing in on pension contributions, which can be quite significant, especially if you're looking to use previous year's allowances to purchase a property, for example. And so for £10,000 of contributions, just by deferring it a year, you'd actually save £450. So you can multiply that up depending on the amount of contributions you're likely to make. And the other point to consider is non-urgent repairs and maintenance. Does the expenditure need to come into the current year? Obviously, if you've got holes in the roof, probably need to sort it, but just review the expenditure before it goes ahead. And then the final point I want to cover in relation to actions before the end of the financial year is less focused on tax, but more on commercial and legal protection. Now, many of our clients would have a holding company in place, so holding company above their trading company. And we'd always recommend paying a dividend up to the holding company prior to the end of the financial year. There's a number of reasons for this, but primarily it's relating to protecting your surplus funds. So if you've got surplus cash or surplus reserves on your balance sheet, if you can move those up to your holding company, you're then protecting them from litigation risk. It is important, however, that this is carefully balanced with the profits that you've made during the current financial year. So just as put some figures to give an example, if you've made £500,000 of profit in the current year, and you declare a dividend at the end of the year of £1 million up to your holding company, obviously the impact of that is it's going to reduce your trading company balance sheet by £500,000, which could have quite a damaging impact on your credit rating. So it's worth just bearing in mind and making sure you run the calculations before you declare the dividend. So then moving on to key actions we want to look at before the end of the tax year, so 5th of April 2023. From my perspective, I think the key point is just to maximise your allowances. Now, I can see a number of the allowances available on the screen, but just to pull out a few and go through those, you can see in the middle we've got the dividend allowance. And really, we want to make sure that every shareholder uses at least their dividend allowance in this current year. As many recall, what this does is it allows the first £2,000 of dividends to be tax-free for the individual. And some will be aware, but that allowance is reducing from 5th of April 2023 to £1,000, and then it will decrease further to £500 in April 2024. So it's really just a case of making sure that everyone who can is using those allowances, and look at those that might not necessarily be a shareholder. So I'm thinking of grandchildren or other family relatives. And for those that have a family wellbeing trust in place, make sure you're really maximising that in this year. And for any that don't have a Family Wellbeing Trust currently in place, what this is allowing you to do is to declare dividends to beneficiaries and make use of their 0% allowances, so the personal allowance and the dividend allowance. Because the key point is that every individual from the day they're born has full access to the personal allowance and the dividend allowance. Another one to pick out from this list is the capital gains annual exempt allowance. So what this is an allowance of £12,300 in the current tax year. And it's the first £12,300 of any capital gain is tax-free. From 5th of April 2023, however, this will be reducing to £6,000 and then £3,000 from April 2024. Now, when you look at the highest rate of capital gains tax, which is 28%, by bringing forward any transactions that you can into the current tax year, that could save £1,764 of tax per person. So have a look at whether there's any options to bring that any change forward. I'm thinking in terms of either residential property where capital gains tax applies, or any share transactions, so partial shareholder buyouts or a sale of shares. And just as a word of warning on this, I'd recommend you make a start on this process as soon as possible. For the main reason being that it's not uncommon for these sort of exercises to require HMRC clearance before they can go ahead, before you can get the legal documents drafted. And getting HMRC clearance is not necessarily a quick process, so it'd be beneficial to start that as soon as possible to avoid missing that deadline. There's also some other allowances on the screen. You can see the inheritance tax allowances, and they're really key to helping to reduce the potential inheritance tax liability that Carl was speaking about earlier, which is going to become more and more important. Carl, did you have some thoughts on actions to take before the end of the tax year?
Thanks, Jack. Yeah, there was just one other point I think needs to be mentioned, really, and that needs to be thought about. And that is an upcoming change called basis period reform. Now, it sounds fairly scary, but it's basically just a change, an upcoming change in the way profits from self-employment are taxed. So anybody that's in a partnership or trading as a sole trader needs to really have a look at this and be thinking about this. And it could have an impact on what you do in this tax year, because the change is coming into effect from April 2024 onwards, but it could really have an impact on what you do in this tax year and how you, the timing of what you do. So I just think it's worth mentioning it. I think it's worth everyone being aware of it, so we can plan ahead for it. So as I said, it's basically a change in the way profits from self-employment are taxed. Up to now, as self-employed or in a partnership, you'd pay tax on profits from your business based on the year end that fell into the tax year. So if you can see on this slide, this is an example here. Just imagine you've got a partnership which has got a year end of June, and we're talking about the year ended June 2022. So the profits that you earn from that partnership for the year ended June 2022, they are taxed in the 22-23 tax year, because the year end falls in to the 22-23 tax year. So that's how it is at the moment. But basically, this basis period reform means that won't be the situation any longer. And from April 2024 onwards, you'll be taxed on the profits that are made in the tax year, regardless of the business year end. So you can see on this slide, this is an example, fast forwarding a little bit to 25-26, and you can see there that the profits that you make in the 25-26 tax year, they are taxed in that tax year, and we basically ignore what the business year end is. But basically, that's not a massive issue in itself because, going forward, it just means that, it will just bring forward the tax payments slightly, I think, for some. But overall, it's not exactly going to result in any more tax being paid in itself. But basically, it's the transition to this new way of doing it that's going to be the problem. So the next slide just illustrates that. It basically means that if you've got a non-March year end, there's going to be a transitional period where you're going to have to catch up. You're going to have to catch up on your profits. And that could result in a significant tax bill. So you can see there, for example, with my June year end, in this tax year that we're talking about here, I'm going to have to catch up. I'm going to have to pay tax on profits for that whole 12 months to June 23 and for the period up to March 24. One tax year. Basically, that large extra chunk will either be taxed in that year, or you can opt to spread it over the next 5 tax years. But there will be strategies you can look at, things like making, the timing of when you make charitable donations, personal charitable donations, or the timing of when you make pension contributions makes sense to, hold off making personal pension contributions now and leaving it to the transitional year where you're going to have that big hit of profits. So that's just really where it bears on the current tax year. So I think, the key thing is you really need to do a forecast of what your profits are going to look like over these next couple of tax years. Forecast it out, look at what your tax liability is going to be with your accountant, and then brainstorm strategies to minimize the impact. So key takeaways, just to summarize on the key takeaways from this afternoon session. Firstly, in the light of what we said earlier, review your remuneration structure. Look at alternative options for drawing money out of your company tax efficiency. Think about those different routes that we talked about in terms of trademarks, pension contributions, etc. Secondly, carry out an inheritance tax assessment. The best thing to do really is just to tabulate your assets and your liabilities and just get everything down on one page. I think is really, really key when it comes to inheritance tax. It's easy to worry about it and think, well, what about this? What about that? What about this asset I've got over there? If you list it all down and actually just assess what is your potential inheritance tax liability, you can then come up with a strategy to minimize that. Maximize the use of the super deduction, as Jack was going over, while it's available. So prioritize any spend that qualifies for super deduction, bring it in before the end of March 2023, if you can. Review your profitability for your latest financial year, whether that's December 22 or not, and consider declaring a dividend up to your holding company if you've got one ahead of the year end to protect any excess profits and cash. And then try to use all available personal tax allowances possible in this tax year. Those allowances that Jack mentioned, things like the dividend allowance, making sure we're using that for all shareholders, for everyone that we can, looking at our welfare trust or family wellbeing trust and maximising what we can do through that. And then reviewing upcoming capital gains, as Jack mentioned, pulling any capital gains into this tax year where beneficial and where you can to take advantage of the higher capital gains tax annual exempt amount that we've got this tax year. And finally, if you've got a non-March year end as a partnership or sole trader, do a forecast of your profits for the next few years and plan ahead for the change in basis period. So we are now going to have a question and answer session. So please feel free to post any questions in the Q&A box that you've got. Got some questions here that we can look at. So first question I've got here: where is the threshold now for it to be worth incorporating, bearing in mind the new tax rates? So that's an interesting question, and there's not really any right or wrong answer to that question. It really does completely depend on the circumstances. The best thing to do really is to do some proper detailed calculations on your situation, to look at it specifically for your situation, and based on how much profit you would want to draw out of your company going forward, your business going forward, and so on. Second question I've got here, got December year end. Will the profits we make in the first 3 months be taxed at 19% still, and then taxed at 25% from April onwards? Jack, you got some thoughts on that one?
Yeah, so what you do is you look at the year as a whole. So those rates we showed at the beginning, that is effectively worked on the number of days, or a quarter at 19% and then 3/4 at 25%. So for a December year end, that would be. So no, we don't split it, but what you do is you look at your taxable profits for the year and then apply that transitional rate, you might say.
Thanks, Jack. Another question here: is super deduction continuing after the 1st of April 2023? So really the answer to that question is that it's not. It's ending at the end of March, and that basically coincides with the increase in the corporation tax rate up to 25%, basically. Another question here: is there a limit to what dividends can be paid to grandchildren beneficiaries through a trust? Got a couple of questions similar on that. I don't know what your thoughts are on that one, Jack.
Yeah, so it all has to be probably worth a specific conversation, but when you're looking at the children of shareholders, it needs to be really tied back to the shareholding that the trust has in the company. So there is a cap for those, and we can discuss specific circumstances. So, but in terms of income for the individuals, obviously they get the full 14,570 tax free as long as they've not got any other income, and above that they're then paid dividend tax rates.
And just to be clear on that, Jack, that 14,000 that we can give them tax free, that's basically made up of the personal allowance, isn't it? 12.5 roughly, and plus the dividend allowance of £2,000 in this tax year. Correct, and as you say, if they got more than that, they would just end up paying some dividend tax. But at the basic rate, that's not huge, is it? Sort of 8.75% is not huge. Another question here: is there any extra relief for the basis period transitional period? Interesting question there, and the kind of more we look at this basis period reform thing, the kind of more we feel it's actually a little bit unfair, because it means you're catching up on your profits to bring everything into line with the tax year, and really those extra profits are basically going to be taxed at the higher rates generally in most people's cases, whereas that wouldn't have been the case if things are just carried on. So it does seem a little bit unfair, but it is unfortunately the way it's working out. But in terms of extra reliefs, the key thing is overlap profits, basically. So you'll be able to claim any overlap profits against those extra profits in the transitional period. So that's one key thing. And then there are some other points that have been included in the legislation to help lessen the blow, just in relation to things like the high income child benefit charge, etc. But the key thing really is to actually assess your situation, forecast out the profits for the tax year is concerned, look at how significant it's going to be, check out what your overlap profits are, take those into account, and then look at what the situation is. It might be that that sparks off a conversation about actually, should we be incorporating now anyway? Or it will spark off some conversations about, time.
Looks like we just lost Carl, but looking some other questions that have come in. Along similar lines, if we made to what we were discussing before about the corporation tax rates, if we made 80% of our profits during Jan to March and 10% from April and 20% from April to December, do pay corporation tax accordingly with the relevant rates. So again, no, it all comes back to that same point where the full 100% of your profits during that year would be taxed at that 23.52% rate. So you could, if you were very confident that that's how it would turn out, you could look at some options in terms of shortening your year or something like that. But you'd have to be very certain of how the profits are going to turn out to make sure it was actually worthwhile. Another question then, is there an available strategy to reduce your IHT exposure down to the threshold and therefore not incur any IHT? I think the key thing on that is really to look at what assets you've got. It all depends on the mix of your assets and what type of assets they are. Some are easier to protect than others. So really, I think it comes back to that point that Carl mentioned about just listing down everything you own and everything that you owe and getting a clear picture and then getting some advice in relation to your specific circumstance, because it does just depend on both the levels and the different asset types. So I think hopefully that's covered all the questions, but if there are any further questions, if you've got any points you want to discuss, then please feel free to get in contact with us. And thank you for attending. We look forward to seeing you again on another event. We're hoping to have an event shortly on the R&D changes, so look out for that, and we'll speak again soon. Thank you.